I feel good about where we are. We're certainly very well positioned to respond to weakness with the policy rate at 5.3%. We certainly have a lot of room to respond if we were to see weakness.
Carrie, a lot of anticipation today. The Fed just released some notes. Powell talked. Break down a little bit. What does it mean? What does it mean to the markets? What do you see as we move forward with interest rates in general?
Well, most of us have been trying to watch it throughout the day-to-day because really the question is, are they going to change rates? A couple things I think that came up. And by the way, these are not in agreement. They can't decide what to do with inflation and employment. Right. And those two don't operate. Now,
they call it the dual mandate.
And I don't know if you could balance both of those out. I think you could do one or the other. So here's what's happening. Inflation gradually, by their measurement, is tanking. Now, we as consumers might not agree with that,
right?
But it is slowing. Some of the things have gotten less expensive. What's going on is their goal is 2%. That's their goal, is a 2% inflation target. They're not there. I'm not sure they're going to get there with employment the way that it is. Now, today, the Fed funds rate is 5.25 to 5.5. They gave a range. They did not lower it. So the question is, as we approach Q4, which is kind of what we at Prevail have thought throughout the year, that's probably if there's a time to get a quarter to a half, we have to get a little more help in the economy. Right? Inflation's going to have to flatten, but this employment part of it does cause me some concern because can you do one without the other?
And job gains slowed a little bit, which is always good. So it was kind of a mixed bag today. How are we reacting?
Well, unemployment is rising. So
right.
Job gains, yes, but unemployment is rising. So can you maintain employment and lower inflation? And that's the part that, there's some really smart people that are involved in that. I'm not sure.
So interest rates is huge. Talk a little bit about what I would say is the underlying real driver, which is the balance sheet and then reducing the balance sheet at the federal funds level.
So what we're talking about is liquidity.
Yep.
And liquidity affects all kinds of things. Banks' desire to lend, mortgage-backed securities, treasuries being sold, agency debt, all those things. So they are gradually unwinding a lot of the COVID money that was scooped up to be able to create liquidity in the market, and they're unwinding that. My concern is the lending environment is not great today the way that it is, especially in real estate and other spaces. But if they unwind that too much more, what does the liquidity do to the market, short-term and long-term?
Yeah, good thing is we're constantly watching it. The markets reacted today, and we'll see what they do in the next meeting.
I think there's more to come.
More to come.